Hello friends, I welcome you in this session. So we are starting with the new series of lectures which is banking sector in India. So we have already covered basics of the monetary policy, about the money, and now we are moving towards the banking sector, right? So in the banking sector we will be discussing about the meaning of bank, different types of bank, then there are various evolutions which have taken place in the banking sector, or we call it the history of banking sector. We will also talk about that, and then we will go to the recent banking sector reforms, different types of bank which have emerged in the last 5-6 years, and similarly we will go through the entire banking sector including the recent developments, right? So in this particular session we will be discussing the evolution of the banking sector in India, right? So to start with, what is the index of this session? So we will start with meaning of the bank, why we need the bank at all, right? Development of the banking system in India, that is the history of banking sector in India, in which we will discuss the different phases of banking sector, the different reforms after 1991, and we will discuss the Narasimhan Committee recommendations and the corresponding reforms, right? So to start with, my question to you is, what is a bank? Right? And when I ask what is a bank, I should also ask why bank? Why bank? Right? So I am giving you 20 seconds to think about it, and then we will start the discussion. So your time starts now. Okay, so 20 seconds is over, and I hope that you must have thought enough, right? Why bank? So as the human beings became more mature, more intelligent, and we entered into the phase of industrial revolution, right? So when we entered into the phase of industrial revolution, the human beings started having surplus of money and surplus of wealth, right? Further, this industrial revolution is based upon the commercial principles, that is the profit making. So the human beings, they are always eager to make some profit out of this money and the wealth, right? So they want to earn some profit from this money and wealth, right? In the industrial revolution, the businessman or the industrialist is always looking for the capital. They are always looking for the capital as a factor of production, right? So they need the capital as a factor of production, and from this capital they are interested in making the profit, right? So they need the money. So overall we can see two things happening at the same time. We can see that there are people who are having the surplus money and there are people who are having the need of the money, right? So there needs to be a platform where this surplus and need, they can come together. They can come together. So this platform is given by the institution called bank, right? So what is the bank? Bank is a financial institution. This is a financial institution, FI. This bank or this financial institution, it is accepting the surplus money of the people in the form of deposits, right? And the same money which is received by the bank, it will give to the another person who is a needy person in the form of a loan. In the form of a loan. So this is the primary function or primary requirement of the bank. So can you see that bank is getting the money from depositors and giving the loan to the other person, right? So this institution is called bank, and this practice, which is this transaction which is happening in this diagram, this is called banking, right? I am sure you are very much clear about it. Now when bank is accepting deposits, it has to perform various activities. It has to maintain the bank account, it has to give the information about the bank balances, it has to allow them to have the checks so that the customer come to the bank, sign the check and get back the money. So there are a lot of activities which are happening on this side. Similarly, there are a lot of activities which are happening on this side. So all these activities are basically part and parcel of the bank because of these two primary functions or these two primary bases of the banks, right? So now I am sure that you are very clear about why we need the bank and what is a bank, right? So let us move ahead. So introduction, bank is a financial institution. Bank is a financial institution that provides banking and other financial services. So now the bank has started providing the non-banking services also, right? So non-banking services like insurance services, investment services. So those are not strictly the banking services. Strictly the banking services means the deposit and loan. They are the two core activities, right, as part of the banking system. And now the bank is also providing the other financial services to their customers, such as accepting deposits and the providing loans. So accepting deposit and providing loan is part of the banking activity. A banking system, right? So this is about the banking system. Banking system also referred as a system provided by the bank which offers cash management services. So keeping the money of the people, allowing them to withdraw as per their requirement, giving them the income in the form of interest, right? Reporting the transaction. So giving them the passbook, giving them the bank statement, giving them the access to the net banking and portfolios throughout the day. The bank safeguards the money. This is very crucial. So banking system is supposed to be very credible so that people are not hesitant in depositing their money in the bank, right? The bank safeguards the money and valuables and provide loans, credit and payment services such as checking accounts, money orders and cashier's checks. The banks also offer investment and the insurance products. So these other financial services, they are basically the investment and the other insurance products. Now, banking. What is banking? So as per the Banking Regulation Act of 1949, right? So this is one of the very crucial law or legislature in India. As per this act, banking is accepting for the purpose of lending or for the purpose of investment of deposits of money from the public, repayable on demand or otherwise, or withdrawable by check, draft or otherwise, right? So let us understand this thing in little bit detail. So as we just discussed, this is a bank. So bank accepts the deposits. The amount which it accepts as the deposit, for example, this accepts rupees 100 as a deposit. So what it can do with 100 rupees? So out of this, it will give some loan. For example, it has given rupees 80 as the loan, and rest of the amount which it cannot give as loan, or maybe it can give but the government does not allow the amount to be given as the loan. Government wants that the bank should have in its own custody for the emergency requirement. So this kind of amount can be kept as the investment into the government securities, etc., investment into the gold, etc. So this is rupees 20, right? So bank is accepting the deposit for the purpose of loan and investment, and this deposit which has been received by the bank allows to return it back in the form of checks, drafts or any other instrument, check, draft, etc., right? So now let us discuss this definition. The Banking Regulation Act of India 1949 defines banking as accepting for the purpose of lending or investment of deposits. Accepting what? Accepting deposits for lending or investment from the public, repayable on demand. So either it is repayable on demand or otherwise means it is repayable after a certain time, which is called as time deposit. So on demand means demand deposit, or otherwise means time deposits, or withdrawable by check, draft, order or otherwise, right? So I hope you can very well connect this concept with your life also, right? So Reserve Bank of India Act 1934 and the Banking Regulation Act 1949, they govern the banking operations in India. So if questions comes in the prelims examination, these are the two acts which actually govern the operation of the banking system in India. Now, government policy on the banking industry, or we can also say what is the need of banking system. What is the need of banking system, right? So need of the banking system arises to protect the safety of the public savings. So now people are having surplus money. They want to keep that money for their future requirement as a fallback option in the oldest time, or maybe they want to expand huge amount in the future. So the government policy is to protect the safety. If bank take the money and don't return back, then no one will give the money to the bank. So this safety is very, very crucial. Second, to control the supply of money and credit, right? So we discussed in the monetary policy that money supply and credit supply is very, very crucial. So this is crucial for maintaining the price levels. This is crucial for economic growth. This is crucial for the industrial development. All round development is based upon the supply of money and credit. Neither it should be too excess nor it should be too less, in order to achieve a nation's broad economic goals. So broad economic goals means industrial development, economic growth, inflation level, etc. To ensure equal opportunity and fairness in the public's access to credit and other vital financial services. So equal opportunity and fairness, this is very, very crucial. So in India, we have a lot of inequality, right? And this inequality is actually reflected in the form of income and wealth distribution. So 1%, top 1% people are having huge wealth and income, and the bottom 55% people are having very meager income and wealth, right? This banking system ensures that the people at the bottom of the economy, they also get access to the money. So a small farmer, a small labor person, they also get to know, they also get the facility of the banking, and they have the fairness also. That means they will also be getting the same rate of interest. They will also be getting all the facilities which are available to a rich person. So this equal opportunity and fairness is very, very crucial. To promote the public confidence, this is very, very crucial. See friends, the banking system is something which channelizes the money from the citizens to the productive place. So if the people are having the money in their pocket or at their home, then it will not be useful for the country. This will be useful only if this is channelized to the infrastructure, industry, or the government. This bank provide the tool or the platform for this channelization, right? So if there is public confidence in the banking system, people will deposit more and more money, and as people deposit more and more money, the channelization and the mobilization of resources will be increasing, right? To avoid concentration of financial power in the hands of few individuals and institutions. So in India, we were having the private control over the banks till 1960s, right? In 1969, for the first time, India started nationalization of the banks. Till that time, the financial power was concentrated in few hands. Now the government policy is to ensure that money is well distributed in the entire population. Provide the government with the credit, right? So government also needs a credit. Government also has a lot of borrowing requirement. Tax revenue. So bank actually provides the channel through which the government can track the financial transactions, and it can see whether the tax is being deposited on the income and wealth of the people, right? So nowadays banks are becoming very, very informative source for the government. To help sectors of the economy that they have special credit needs, for example housing, small business, and agricultural loans. So all the sectors of the economy, the industrial, the agriculture, housing sector, infrastructure, small businessmen, they need the credit. So the government policy is that the credit is provided to all the sectors of economy. Now, the banking sector's history in India. So the banking sector's history or the evolution of banking sector over a period of time, we can see in different phases. So there are total 5 phases, right? And after this we have 2 more phases which we will be discussing subsequently. So the first phase is evolutionary phase till 1947, right? So till 1947 we were under the British control. They were banks, the banks were mostly privately controlled, and the banking system was good enough to provide a sound foundation in the later on time. Foundation phase, so between 1947 to 1968, we were consolidating, we were making the laws, we were establishing the central bank, we were trying to figure out that what should be the future course of action. Expansion phase, this was the expansion phase. Consolidation phase and reformatory phase. We will discuss each one of that. So starting with evolutionary phase. Evolutionary phase or the pre-independence phase. Pre-independence phase. So it started in 1786. 1786. More than 230 years ago, right? So the origin of the banking sector in India, it can be traced to the city of joy, right? Bank of Calcutta, right? So Bank of Calcutta was established in 1786. The Bank of Bengal, Bank of Bombay, and Bank of Madras. So these were the 3 presidencies. They were established in the 19th century and they were merged in 1935 to to form the Imperial Bank of India. Friends, let me tell you one thing, right? So you can see a lot of facts over here. Now the question arises, for the UPSC prelims examination, do you need the facts? The answer is not necessarily. You just need to have an idea. You should be sufficiently interested in this session. But it is not that you have to remember each and every fact, right? So you don't need to remember 1786. You don't need to remember 1935. These are the banking level questions, clerical level question, or maybe they will be asked in the other examinations. I respect those examinations. I am not undermining their importance. At the same time, what I am saying is that for the UPSC, you don't need to remember each and every fact. However, you should be sufficiently interested so that your answer can be derived in case there is some remote hint you can draw from this information. So this session will be more of informative, less of conceptual. So be attentive. I don't think you should make the notes. The note making is not required in this session. You should just listen interestingly, and you should revise the PDF notes and underline the important points, right? So the this Imperial Bank of India was constituted in 1935 by merging the three presidency banks. The first Indian owned bank was the Allahabad Bank, and it was set up in the 1865, right? RBI, the Reserve Bank of India, or the Central Bank of India, was established in 1935 under the RBI Act 1934. In the foundation phase, first of all, this starts in 1949 and it continues till 1969. The point to note is that till independence, the banking sector was primarily under the ownership of the private ownership, right? And there is a specific feature of the private sector. Can you guess it out? What is the specific feature of the private sector? So the specific feature of the private sector is that they are interested in making the profit. So they will give the loan to the person who can provide them some profit, right? So they are not interested to give the loan on social factors. They are interested in giving the loan on the commercial or economic factors. So they are giving the loan to the industrialist, to the people who are already rich, right? They are not giving the loan to the people who are at the bottom of the economic pyramid, the people who really need the money, the farmers, the small businessmen, for the government. So they are not interested because those sectors may not be profitable, right? So because of this strategy, the rural population, they were basically becoming dependent upon the small money lenders. So because the banking sector was privately owned, the banking sector was not ready to give loan to the farmers. So the farmers have to go to the small money lenders and they get the loan from there. Small money lenders, they will always exploit in the form of high interest rate, in the form of bonded labor, manipulating the accounts. So they will actually exploit the farmers and the laborers. To solve these issues and better development of the economy, the government of India nationalized the Reserve Bank in 1949 itself, right? So the central bank was nationalized in 1949 itself. Nationalization means the government ownership. So the government acquired the ownership of the Reserve Bank of India in 1949 itself, right? So this event actually shows the importance of the banking sector. The Banking Regulation Act was enacted in 1949. In 1955, the Imperial Bank of India was nationalized and the State Bank of India was basically, this Imperial Bank was renamed as the State Bank of India. Then we have this 1969 to 1991. So in this phase, in 1969, 14 commercial banks, they were nationalized. And from 1980, 7 banks were nationalized. expansion phase or nationalization phase, right? So why the nationalization was required? Nationalization was required so that the people who really need the money, they can get the money, so that there is equality of income and wealth, so that there is financial inclusion, so that there is proper development of the agriculture sector. So friends, till 1969 we already completed 3 5-year plans. With the experience of 3 5-year plans, we got to know that agriculture sector is not getting suitable credit. So to provide credit to the agriculture and the other social sectors, the nationalization was done, right? So nationalization was done. So in this phase, the year 1969, this is called the first banking revolution or start of the banking reforms in India. This nationalization is also called as the socialization of banking. Nationalization of 14 banks to make banking services reach the masses, right? So 19th July 1969 is the date on which the nationalization happened, and the purpose was to take the banking services to the masses, not just keep it as the privilege of the rich class. Rapid branch expansion, credit creation, deposits mobilization, this happened. So banks were opening their branches in the rural areas, in the villages. More and more credit was being created, more and more people were depositing their money in the bank, and the bank was channelizing that money further to the other productive sector. Penetration of banks into the rural areas. Banks funded all the major government projects. So the government was carrying out many projects. In the infrastructure sector, the power projects, multi-purpose dams, then the direct attack on the poverty, the Garibi Hatao scheme was also focusing upon a lot of spending from the side of government. So all these was funded by the banks. Second phase of banking revolution came in April 1980 with nationalization of 6 more banks. Then in 1975, the regional rural banks, they were born. The concept of regional rural bank was created. In 1982, the national level bank for the agriculture sector was created, NABARD. Number of commercial banks, they were reduced because of the emergence of the regional rural banks. Now, from 1984 to 1990, it was the consolidation phase. Why we needed this phase? Because the competition was declining. Why the competition was declining, right? So the reason was that major of the banks, they were nationalized, right? That means there was government ownership, and when there is government ownership, there are some issues. The issues of unnecessary political interference, right? So there is political interference. Then there is job security for the people. When there is job security, then they are not interested in performing, right? I'm not saying no one is interested, but majorly the people are in the survival only. They are not interested in performance. Then they are having the monopoly. There is no competition from the outside. There is no private sector. The person has to come to the government banks only. So there is monopoly, and because of this monopoly, the bank's efficiency is declining. So there is gross inefficiency and loss of control was spread in the many offices. Customer service was the least priority. So the banking officers, they become the next level of bureaucracy. So the people, the farmers, the illiterate people, they will always be fearful about the banking officers, right? They will treat the banking officers like the gold man. So this was the culture at that time. The performance of the banks was measured in terms of growth of deposits and the advances, right? So the money they are receiving and the money they are giving as the loan. This was the major criteria. The quality of the services, the quality of the services, it was completely neglected. So friends, reformatory phase started after 1990, right? So friends, 1991 was the year in which the Indian economy took a big shift, right? So why the reforms are required? Because the Indian economy was completely shattered. How it was shattered? There was huge debt or loan over the Indian government. We were not able to repay the foreign exchange payments after a certain time, right? So the foreign exchange reserves were very low at that time. Apart from that, we were facing the challenges on the front of inflation. The rate of inflation was more than 10%. The public deficit or the fiscal deficit was also very high. So all the economic fundamentals, they were showing that Indian economy is completely shattered. In the banking sector also, there were huge problems that were existing, right? So the reforms were initiated in the middle of the current account crisis. So 1991 is called the year of BOP crisis, balance of payment crisis. What is balance of payment? This thing we will discuss while we discuss the external sector chapter, but you have to understand that this BOP crisis was the major factor. The India was having huge import and still it was not able to repay the payment for the import that it did. The crisis was caused by poor macroeconomic performance. So the macroeconomic fundamentals or the macroeconomic indicators, they were completely shattered. We talk about the public deficit or the fiscal deficit, right? So fiscal deficit is what? Fiscal deficit is the difference or basically the excess of payments or expenditure over the income, right? So when the payments or expenditure is more than the income, this is called deficit, and it was reaching 10% of GDP. Normally it should be within the limit of 3%. Current account deficit, it was also very high. So imports were high and export were negligible. Inflation rate was very high, right? The domestic and the foreign debt was very high, and the oil price was at a very boom. Why boom? Because of the Iraqi invasion of the Kuwait in 1990. Because of this, the oil prices were growing, and the impact of oil price growth is that there is inflation because every sector, whether it is the agriculture sector or the industry, they are using the oil. Secondly, it causes the cost of domestic products to increase. Because of that, the exports become difficult. Then the government has to give the subsidy from the pocket. Because of that, the fiscal deficit becomes high, and because of the increase in the price, the value of the import increases. So that also leads to the current account deficit. So just because of the oil price boom, the inflation is also increasing, current account deficit also increasing, public deficit is also increasing. So we can see that each and every fundamental has been adversely impacted because of this boom. Now, the first phase of the reforms of the banking sector after the 1990, right? So it started in 1991. In 1991, the very famous committee, Narasimhan Committee, was constituted. Narasimhan Committee 1, it was constituted to restore the financial health of the commercial banks and to make their functioning efficient and the profitable, right? The recommendations basically aim to provide the flexibility to the banking operations. The committee submitted its report in November 1991 with the 23 recommendations, right? So before we discuss what was the recommendation of this committee, let us see what was the state of the banking sector at that time. Pre-reform era or we can say up to 1991, what was the status, right? First, administered interest rate. Interest rate is the rate which is given by bank to its depositors as well as charged by the bank on its borrowers. So this was administered. Administered means it was under the control of RBI. So the RBI will decide how much is the interest that will be given or charged by the banks. That means there was no control of the bank. The bank were not the interest rate, which is the major source of income for the banks, that was not driven by the commercial principles, that was driven by the government interference, and because of that most of the banks were in losses, right? So the focus of the government was on the social sector, but as an adverse impact of that, the health of the banking sector was degrading day by day. So this administered interest rate actually led to the losses in the balance sheet of the banks. Quantitative restrictions on the credit flows. So there was huge restrictions about the credit flow which can be made to the particular sector, to the industry, right? Because of that, the banks were not able to drive the income from the profitable sectors. High reserve requirement. Reserve, what is the meaning of reserve? The money which is kept with the bank, with itself or with the RBI or with in the government security, so that the same money can be used at the time of emergency and for the day-to-day operations. So these reserves, the quantity of these reserves was very, very high. So you will be surprised to know that SLR was very, very high. This was approximately 38%. The CRR was also very, very high, approximately 18%. So can you see that SLR and CRR, they are more than 50%. That means more than 50% of the money cannot be given as the loan by the banks. They have to keep with themselves, or they have to give to the government, or they have to either they have to buy the government security, or they have to keep with the RBI. So there was a lot of money which was locked up in the banks. That money was not able to create the further credit. So sufficient money was not available in the economy. So this high reserve requirement was also one of the big problem. Imposition of stringent regulations by the RBI. So there was huge regulations. There was huge restriction on opening the new branches, on issuing the new kind of instrument, on opening the new bank accounts. There was huge restriction on the private sector. The private sector was completely disallowed, and because of that, the public sector banks, they also become inefficient. There was no competition, so they started having the problems related to the monopoly. They started enjoying the monopoly, and they were not reforming themselves. They were not trying to improve themselves because there was no competition. Low productivity or efficiency in the public sector undertaking banks because of the stringent regulation, because of the no competition, because of the no existence of the private sector. Deteriorating portfolio quality or increasing NPA. So the loans which were given by the banks, they were becoming bad because the economy was also doing very bad. The current account deficit was high, inflation was high, industrial growth was very, very poor, and because of all these reasons, the non-performing asset or the bad loans, the amount which cannot be recovered by the bank from the customer, this amount was increasing day by day. So this was the condition at that point of time. Now you can think that how much was the requirement of the reforms, and now let us see the different recommendations which were given by the Narasimhan committee and how they were implemented. First, lowering the SLR and the CRR. So SLR and the CRR, they were brought down to sufficiently low levels, right? Still they were high. Over a period of time they have been decreasing, but the point is that their level was decreased so that the money was released into the banking system. Prudential norms. Prudential norms means regarding the NPA, on the NPA, the provisioning requirements started. Provisioning norms started. That means if the bank comes to know that a loan has become bad, it will keep aside 10% or 20% or similarly up to 100% of the amount as the losses. So it will assume that this amount has become bad, and correspondingly this will actually be coming into the profit and loss account. This will be counted as the loss, or we will be making the provision, right? So these prudential norms started so that the bank's balance sheet can give the fair picture. There is no manipulation in the banking system. Capital adequacy norms. So capital adequacy, the banks should have the adequate capital. So the Basel norms were actually implemented, and this capital adequacy was ensured. This capital adequacy started from the 3% level and went up to the 12% as of now. Deregulation of interest rates. So the interest rates were made market driven. That means the banks can decide what will be the interest rate on their loan, right? So they can also focus upon the profit making. Their health can also improve. Recovery of debts. For the recovery of debts, the new acts like Debt Recovery Tribunal Act, they were started, and because of that the recovery became easy. Competition from the new private sector banks. So the new private sector banks were given the licenses. Around 20 new private sector banks, including the foreign banks, they were allowed, right? So you can see the ICICI, HDFC, Axis Bank, all these banks are actually they actually got the licenses at that point of time. Phasing out of directed credit. So control over the credit was minimized. Access to capital markets, the banks can go to the capital markets, they can issue the capital, and they can raise the amount of capital. Local area banks were started so that the era of specialization can be there. Supervision from the commercial banks, it was relaxed. So RBI supervision over the commercial banks was relaxed. Second phase of reforms of banking sector in 1998, again the Narasimhan Committee 2 came, and it focused upon the structural measures and improvement in the standards of disclosure and the level of transparency, right? So here the focus was upon structural improvements and disclosure and the transparency. Now, implemented recommendations from the second Narasimhan Committee. Number one, they focused upon the new areas, right? They focused upon the new areas which were not covered in the first committee recommendations. New instruments, they allowed new kind of instruments so that there is more diversification of the instrument and the banking services become more efficient for the customer. Risk management, they allowed the banks to manage their risk, to have some amount of their deposit into the investment. Customer service was made the priority. Universal banking started. Universal banking means apart from the banking, the bank can also do the insurance work and the investment work. So the core banking was extended to the other areas also. Information technology was started increasing in the FDI limit, so the foreign sector was completely allowed to invest into the banking sector. Mergers and amalgamation, it started, it was allowed so that more and more banks can come together and form the big banks. Guidelines for anti-money laundering. So to avoid the money laundering, to avoid the conversion of black money into the white money, these anti-money laundering guidelines were issued. Managerial autonomy, this was there so that the political interference can be minimized and the commercial principles can be used in the management of the business. Increase of inflow credit. strengthen the technology, base rate system of the interest rate, right? So base rate means there will be some minimum rate at which the loan can be offered. So some minimum rate was kept so that there is fairness and justice across the customer segments. Adoption of global standards and management of NPAs, right? So all these things were there in the second Narasimhan committee recommendation. So overall banking sector's history we have already seen: evolutionary phase, foundation phase, expansion phase, consolidation phase, and the reformatory phase. Now after this comes the financial inclusion phase, right? So in this phase we have the payment banks and the small finance banks. What are they? They are basically differentiated banks. So they are payment banks are focusing upon the payment, and the small finance are basically small, and their focus is upon the micro financing. Their focus is upon basically the spread of the banking sector into the inaccessible areas, right? So we will be discussing the detailed feature of the payment banks and the small finance banks in the upcoming sessions. Then we have the bank mergers. In 2017, SBI was merged with 5 of its associates. In 2018, the Bank of Baroda, Dena Bank and Vijaya Bank, they were merged. In 2019, the Indian Bank to be merged with Allahabad Bank, PNB, OBC and United Bank to be merged, UBI, Andhra Bank and Corporation Bank to be merged. Friends, you don't need to remember which bank was merged with which one. That is not absolutely necessary, but you need to see that in all the 3 years there is a huge focus upon the merger, because the government want to have the few big banks so that there is synergy of operations, the cost is minimized, there is no duplication of the staff and the infrastructure, there is no unproductive competition, the benefit of the technology can be harnessed, and our bank can go global. So because of all these requirements, these all banks are being merged. So overall we can see after 1991 M. Narasimhan committee report, then foreign banks came, private banks came, phone banking and net banking also came, digital banking also came. So we will have a separate session on the digital banking, and now the merger of the banks is happening. Now question of the UPSC, very interesting thing, very easy question. This question came 2009. In the context of independent India's economy, which one of the following was the earliest event to take place? Option number 1, nationalization of the insurance companies. Option number 2, nationalization of the state bank. Option number 3, enactment of the Banking Regulation Act. And option number 4, introduction of first 5-year plans, right? So these are the 4 events. I know this is a little bit factual question, but if you are interested enough, then you can solve this type of question. So coming to the answer, nationalization of the insurance companies, it started in 1950. Nationalization of the state bank, it was done in 1960. Enactment of banking regulation was in 1949. This nationalization was in 1955, and introduction of first 5-year plan was in 1950. So in the context of India's economy, which of the following was the earliest event to take place? It is basically enactment of the Banking Regulation Act, right? So this is the first event to take place, right? So with this we complete this session. Thank you very much. Stay happy, stay learning. God bless you.